of resources. So welcome and to this session. I hope that you all see the screen. This session is part of the Cooperative Skills Series 2022. And today we will talk about managing your finance with Andy. This is a part of a series of webinars on co-ops that we started in February this year, and we will end in June, most likely. So you can see all the co-ops that we met in February at Zora and Eden Dairy, but also the skills that we tried to develop and share among the cooperative movement. And in April, May, and June, we have decided to avail of the experience of a very, very seasoned practitioners from UK and far afield. So in May, we have, in April, we have invited Mark Simon from England, culture.coop, and we done a session on business in the community and cooperatives ownership. And in May, we started a kind of journey around the finance and capital raising with Andy, our today's host. And through May, we just talked about very much about how to raise finance in the cooperative way. But today we will talk about how to manage finance in your cooperatives. Don't forget, we have something about governance at the end of the month, on the 22nd of June, with another very experienced practitioner called Abby Kempston. So please do join us if you can. You know that there is always a support available in cooperative alternatives, but now also support through this very experienced practitioner. So managing your finance demystified is another webinar supported by the Belfast City Council. So we thank them for their support, and we just now let Andy take over and maybe introduce yourself, Andy, to this new group of people. Thank you.
Thanks, Tiziana. Hi, everyone. So my name's Andy. I am a co-op development worker and a community shares practitioner. I mostly work in the UK, although I now live in Germany. Am I too quiet? No. Okay. I have a specialism in finance. I have no formal accounting qualifications. I wasn't trained in finance. I just started doing the finance in my housing co-op to start with, and then other people, and then various working co-ops. But basically people went, oh, you seem to know what you're doing. Can you help us? And therefore I've become a finance specialist as a co-op development worker. But I think I should always say that, you know, if you're looking for a qualified auditor accountant, that's not me. That's not my my role. Yeah, there we go. I should probably just start because there's quite a lot to try and get through. But please stop me, ask me questions if I say something that I don't understand. I'm hoping to leave time for questions at the end. You do not have to. Please feel free to just write down everything that's on the slides if that's how you learn. But you will have a copy of all the slides, so you do not feel obliged to write everything down. It's probably the right way to say it. So yeah, unless there's anything to say, I'm going to share my screen with you. Oh, you might need to make me a co-host, Tiziana, so I can do that. Cool. Can you see? Great. So what we're going to talk about today, this is actually one of those sessions that could be a day long. I do a regular how to understand your co-op's finances, which is either a day long or 2 half-day sessions. Yeah, so to try and work out what's important and what we can fit into a 2-hour webinar, is quite tricky. But what I have picked out was what are the legal requirements for you as business members, owners, however you want to refer to it. There are a number of legal requirements that you have to be aware of. So I thought that was a good place to start. We should at least, just tell you what they are. And then going to talk about how we use bookkeeping to meet those statutory requirements. So why it's important to keep your books, and what you can use, various options available to you. I might even make some recommendations, but obviously that's a partly personal preference, and also, it's some of these things are proprietary, and I'm not actually paid by these people. I'm just, the software is available, I think, is probably the right way to say it. And then this isn't a requirement. The last thing we're going to look at isn't a legal requirement, but it's good governance and good practice for any business or any organization. Is to think about what may happen in the future. Yeah. So we're going to look at, and very specifically to look at what's going to have effect that's going to have on how much cash you have as an organization. So there are lots of risks to businesses, and there is more than one way for a company to go into insolvency, to file for involuntary insolvency in the UK. One of which is to be technically insolvent, so you owe more money than you own, and the other of which is to run out of cash, which means you can't pay obligations as they come due. More than 80% of all insolvencies in the UK happen because people run out of cash. So it's the biggest risk to your business. So when we look at talking about managing risk in a business sense, what we're mostly interested in is how much cash can I get my hands on? And do I have enough cash to be able to pay the things that I have to pay? So we will look at predicting how important it is to predict what's going to happen to your cash flows, and also how that will tie into various risk management strategies, scenario planning. I hope this is kind of what people were expecting to see today. It's a bit late now for me to write a new set of slides, but we'll see. Do just ask me questions as well. So when we talk about your statutory or your legal requirements, obviously it depends upon what your legal structure is, what you're registered as or incorporated as. But if you are a society, either a cooperative society or a community benefit society, then the main act that regulates societies provides a duty for you to keep records. And you must keep books in a particular format that enable to get a true and fair view of the society's affairs. So you need to keep a record of your books of account, which means you're sort of like what you own, what your profits and income, what your incomes are, what your expenses are, how much cash you've got, and how much money was paid into you and how much money you have paid out. That's what those things mean. And that is a legal requirement if you are registered as a society. If you're registered as a company, then you also have a duty to keep adequate accounting records. It's in a different act, but you still have this duty. And the adequate means that they're sufficient enough to show and explain the company's transactions, and to be able to disclose within reason at any time how the company is doing. So the financial position of the company, which is effectively what used to be called the balance sheet. So like, how much stuff do you own? How much stuff do you owe? How is that made up? Yeah. So there's a legal requirement once you are incorporated, either as a society or as a company, to keep records. So you have to start doing it. Yeah. both companies and societies then have to prepare annual accounts on top of that. So you have to keep a record of your transactions as you're going. On a day-to-day basis, you have to keep a record of your transactions. Every year, you must prepare a formal set of accounts. And these have to be to a specific financial reporting standard. If you are a society, unfortunately, so if you're a cooperative society or a society for the benefit of the community, you have the more onerous financial reporting standard, which is Financial Reporting Standard 102, and you don't have a choice. You've got to report to that standard. This is probably not so useful for you because it's complicated, and for most people, that the requirements of the financial reporting standard are difficult to understand. However, what is useful is if you have an accountant, you can say to your accountant, when you complete our accounts, you must complete them to FRS 102. And if you are thinking of doing your accounts yourself, then you need to know what the reporting requirements of FRS 102 are, or know that you can't do that and you need to get an accountant. If you're a company, you'd actually have a choice. Well, if you're a smaller company, and I'm imagining we're dealing with mostly smaller companies, small being turnover of less than several million. So that, generally works as far as I'm concerned. Then you've got a choice of a slightly less full-on financial reporting standards, FRS 105 or FRS 102. So if you're registered as a company, your accountant can prepare them in either of those two. Yeah. Now you must submit your annual accounts. You don't just do them up. You've got to do them up, and your members have got to look at them and they've got to go, yes, that's true. But you also must submit them to various regulatory bodies. So if you're a company, you must submit them to the Belfast office of Companies House. I didn't realise there'd be anyone from the Dublin Food Co-op here. Sorry, I actually don't know who you're supposed to. This is very UK specific legislation, and I've gone and checked where the Northern Ireland office is, but yeah, sorry. So if you're a company, you submit them to Companies House, and there's a Belfast office, and that's who you'd submit them to. If you are a private company, so either a company limited by guarantee or a company limited by shares that isn't traded on the stock exchange or isn't a community interest company, then you can and actually must use the HMRC's online portal called Companies and Tax Online. If you're a community interest company, you cannot submit electronic accounts, and you have to post them to the Companies House Belfast. And you have to do this within 9 months of your year end. So if you're a company, before 9 months after your financial year end, you must have a completed set of accounts that have been submitted to Companies House, either in writing or online using Companies and Tax Online, Cato. Questions? Okay, now it's different if you're a society, sorry. If you're a society, you do not submit anything to Companies House. You have to submit your annual accounts to the Financial Conduct Authority. That's what FCA, Financial Conduct Authority. And you submit them along with what's called an annual return. The form is called AR30 if you need to do it. You need to do this within 7 months of your year end. And you can either download the form, fill it in, print it off, and post it to them, or you can use the online mutuals portal to do this. However, they are consulting at the moment of moving everything over. You'll hear this a lot actually throughout this webinar. They're consulting about moving everything over to an online version. So within the next few years, you will need to use the Mutuals portal. So if you are a society, do get your head around the Mutuals portal, because you're going to have to use it. It's not difficult, it really isn't. Questions on your annual accounts? No? Hopefully you'll just go to the, you will now be able to go to your accountant and say, oh, our accounts need to be drawn up to this standard. But yeah. So if you employ anyone, now a lot of people don't know what they, a lot of people think that they don't employ people. I spend a lot of my time persuading people that they are actually employing people that they think are self-employed. The rules on it are quite complicated. If you aren't sure, assume that you're employing someone, because it's safer in the long run. Yeah, be conservative. But before you pay anyone through a contract of employment, a contract of services, you must register as an employer. You register with HMRC. And once you've registered as an employer, all of your payments to your employees must go through pay as you earn, PAYE. You don't have a choice. You can't pay people any other way. They've got to be paid through PAYE. And not just they've got to be paid through PAYE, but you must notify HMRC that you're about to pay someone before you pay them, each time you pay them. Which is why it's quite good to start paying people monthly rather than weekly, because there's a lot of notifications and a lot of returns. This is called RTI, real-time information. And whatever you're using for your payroll, therefore must be RTI compliant. Not all payroll software is RTI compliant. Most of it is these days, but so you need to check, is my payroll software RTI compliant? If you are, if you're using modern online cloud-based bookkeeping software, then the chances are it will be. If you have an old copy of QuickBooks that's on your computer, then it probably won't be, yeah? So you need to check that. There is free software that HMRC provide. It's called Basic Tools. It's like I've managed various payrolls through it. It is basic, if I'm honest. It's clunky and basic, but it's free, and they will, and it's perfectly usable, and you can download it. If you just type in HMRC Basic Tools into Google, you can download it for all operating systems. It works just as well on Linux as it does on Windows. So I say just as well. You probably have to write a little script that HMRC actually provide for you these days, so that's quite good. So you just have to register, and you just have to let people know. You have to let HMRC know each time you're paying people. Any questions? If you employ people, you must also check if they qualify for pension auto-enrollment. So you'll hear a lot of rubbish said that workers' co-ops don't need to do this. It's nonsense. Yeah, directors don't need to do this for payments that are made as director's salary. But if you're a workers' co-op, you have two roles. You have your role as a director, if you're managed by general meeting, etc. You have your role as a director, and you also have your role as the person doing the work as an employee. So you're also paid as an employee. So the stuff where you look at your accounts and you have meetings, and that's director role. the stuff where you move food around in your whole food shop, that's employee stuff. Yeah, you're actually delivering the stuff that the company does. So on that basis, you are actually employed, and therefore you will fall under this pension auto enrollment scheme. If you have annual earnings, so if you as an individual or have annual earnings of above £10,000, then you must automatically be enrolled in a pension scheme. You have the choice to then opt out, but you automatically qualify. Yeah. You as a company or a society, as a co-op, you cannot put any pressure on people to opt out. Yeah, that's got to be a voluntary thing. If they have earnings of above 6,240, then they have the choice, the right to opt in to the scheme. And if they opt into the scheme, then you've got to allow it. And that means that they will have some money deducted from their wages, which will go towards their pension scheme, but also as an employer, you will have to pay a contribution. It's a minimum of 3% of the qualifying earnings, which is the earnings worth 6,240. Obviously, I can't make recommendations about what's the best pension scheme, but if you want to know what the easiest pension scheme to meet the requirements of the auto enrollment in the UK, it's NEST, N-E-S-T. And it's just really simple, and it's set up for people who don't really think about having a pension scheme, but need to because of auto enrollment. Yeah. They have a slightly more ethical. They have two options. So you can choose a slightly more ethical one. I'm not a pensions advisor, so I'm not going to make any recommendations as to what's a good pension scheme. Yeah. Questions?
Yeah. Can I ask you one question? If one of the employees opt out, would the co-op able to contribute to a pension fund that is a private pension fund rather than?
I mean, the co-op can choose. This is a statutory minimum.
Okay.
Yeah, this is a legal requirement. You can do whatever you like. You can actually pay people more in I mean, I think there's a limit, but you can pay people most of your wages in pensions if you want. I mean, most people want the cash now, but there are tax incentives to pay into pension schemes. So.
Okay, thank you. Yeah.
We're almost there with your statutory and legal requirements, but there are a fair number, so you just have to be aware of them. So the VAT is the next one. So if you have what's called a Vatible turnover, so this is the turnover of trade of goods and services that would have VAT added to them, even if it's zero rated. Yeah. So there's a number of different VAT rates. There is the standard VAT rate, there's the reduced VAT rate, there's the zero VAT rate. Now, all of these things are under the VAT scheme. They class as Vatible turnover. And then there's exempt and outside of the scope, which effectively we might as well bundle together for this. And they're things that aren't Vatible turnover. So things like insurance, housing. Yes, if you're a housing co-op, your Vatible turnover is probably zero. Yeah, if the only thing you do is provide housing, then there is no VAT. It's outside the scope, and so you don't have to worry about it. If you're getting a grant, if you're a grant receiving body, some grants are inside the scope, some grants are outside the scope. It depends on what you're giving in return for the grant. Is it actually a contract to deliver some services, in which case it might be inside the scope. Is it a freely given grant where you don't have to fulfill any obligations, in which case it's probably outside the scope. So this can be complicated. However, if your Vatible turnover, so the turnover of things that are inside the scope of VAT, is greater than £85,000 over the last 12 months, and that's always over the last 12 months. It's not, what was it in the last financial year? It's, okay, we're now on the 1st of June. So what was it from the 1st of June 2021 to the 31st of May 2022? And next month, it will be, well, what was it from the 1st of July 2021 to the 30th of June 2022? Yeah? So it's a rolling basis. If your turnover is greater than £85,000, you are legally required to be VAT registered. Once you're VAT registered, there's then a whole host of other obligations, like you must charge VAT at the appropriate rate on the goods and services that you provide. It is also possible to voluntarily register for VAT. You don't have to have a turnover of more than £85,000, but you have to be undertaking your business has to be the provision of goods and services that fall within the VAT scheme. So you cannot register for VAT if all you do is provide housing, for instance, because the housing isn't part of the VAT scheme. What's important in terms of the statutory requirements is that if you are registered for VAT, you're probably going to have to submit quarterly VAT returns. There are some complicated schemes where you can get away with submitting an annual return, but for most people, you will be submitting quarterly VAT returns. And your VAT returns must be completed using Making Tax digital compliance software. So if you think your turnover is going to become greater than £85,000 and you're future-proofing what you're going to use to do your record keeping, then you would want your record keeping to be done under Making Tax digital compliance software. Because once you are VAT registered, you have to use Making Tax digital compliance software. I'm asking for questions, but I don't want questions on what rate is this VAT, because
can I ask a question? And it's not about that, but you said that housing is a bit particular about VAT. What if are you building a house? You know yourself, if you're building something, the VAT bill can be quite substantial if you are buying construction material, for instance. In our experience here in Northern Ireland, we had a very kind of unusual decision of HMRC, and I couldn't understand why they were kind of refusing some of the registration for VAT when we are talking about construction or improving buildings.
So it's what you undertake as a trade that matters. So you're not undertake your trade unless you're a construction company.
No.
Your trade isn't constructing buildings. Your trade is what you then do with the buildings afterwards. If what you're doing is providing housing, then your trade is housing, and housing is outside of the VAT scheme, so you cannot become VAT registered. If, however, the person who is delivering or providing the construction for housing shouldn't be charging you VAT on the goods and services, because the building of new housing, if it's new housing, is zero rated.
Okay.
Yeah.
Okay. This is very complex, I know, but thank you.
It gets very complicated.
But as I said, we were kind of surprised but now it makes a bit more sense. Thank you.
Yeah, the fundamental basis is that you can only register for VAT if you are undertaking a trade which you would charge VAT on. Yeah, even if that's 0 rated VAT. Yeah, so some businesses, say for instance, food co-ops, certainly whole food shops, voluntarily register for VAT, even if their turnover is under the £85,000 threshold, because they're charging VAT at 0%. So in effect, they're not actually charging any, but they're inside the scope of the system. And it means that they can claim back the VAT that they have paid. It's a sort of a backdoor government subsidy for various things, such as food. Yeah? Any more questions about VAT? No? Cool. So the thing to bear in mind, though, is if you are VAT registered or if you're going to be VAT registered, you now, since 2019, need to have Making Tax digital compliance software. Yeah? That's the key take-home message from this. Yeah. So annual accounts were a requirement if you're incorporated. Depending on how you're incorporated, the requirement to FCA or to Companies House. PAYE is a requirement if you employ someone. VAT is a requirement if your trade is over £85,000. Corporation tax is a requirement for everyone. Yeah, you do not have to be incorporated to be required to submit a corporation tax return. The moment you start trading, you are liable for corporation tax. So this is a tax on your tradable, on your surplus, and it is any organization. So you can be an unincorporated organization and still be required to complete a corporation tax return. You are still required to complete a corporation tax return even if there's no tax to pay or if you make a loss. However, it is possible. So we're going to go back to housing. So housing co-ops do not pay corporation tax on rental income from their members, which generally means that if that's all they do, they don't pay corporation tax. However, they still have a legal requirement to fill in a corporation tax return, because the return is not about how much tax you have to pay, it's a requirement to fill in this return. If you get in touch with HMRC and say, this is us, we'll never have to pay tax, can we please be exempt from filling in a corporation tax return? 9 times out of 10, they'll say yes. And they'll give you a 5-year, or maybe yearly, but often a 5-year, get back to us in 5 years, tell us if anything changes. So exemption, which is really handy. So if you're in that category, think about the exemption. If you're not in that category, you just have to fill one in. You have no choice, unfortunately. You have to pay the tax within 9 months and 1 day of your financial year end, and you have to submit the return within 12 months of the year end. Now, I generally say to people, if you need to know, to get your tax right, you often have to fill in the return. So you might as well do the return within 9 months and 1 day, because then you know how much tax you've got to pay and you can pay it. Yeah? If you're a company, you can file using this Corporations and Tax Online, Cato. And it was set up to make it so that small businesses do not have to get an accountant to file their tax return for them. So you can do this as as a small business. Unfortunately, it was often, like many of these things, it was often set up with companies in mind, because companies make up the vast majority of businesses in the UK, and societies are very small. And so societies aren't really catered for. However, if you are a society that doesn't have anything that's unique to societies, like interest related to share capital, a complicated tax exemption, or income that isn't trade related, like grants, you can kind of fit yourself into Cato just about. I mean, I've asked, we phoned HMRC about it a few times and they've said, just lie. Yeah, so you can do it and they expect you, they're not going to come down hard on you. However, you can't do it if you've got any of these things. Yeah, if you've got £1,000 of income that isn't trade related income, then you can't use this. If you want to account for interest on share capital, you can't do this. Yeah. So then you'll need to use actual proper tax filing software. And again, that then becomes more complicated if you're not an accountant. Yeah, accountants, that you need to be registered as a corporation tax agent to use most tax filing software. So if you're not so basically all I'm saying is that unless you can shoehorn yourself into Cato, you're probably going to have to go to an accountant. So making tax digital, which is the one we talked about for VAT, it's also going to come in for corporation tax at some point. They're consulting about when, or they've just consulted about when, but it's a policy, UK government policy, to make all tax digital by some point. And that means that from that point onwards, you'll need to use making tax digital for corporation tax compliance software. But I think it's April 26, is that what I said? Sorry, it's actually hidden by your faces. Yeah, April 2026 is the earliest that it's going to come in. So you've got a bit of time on that. Questions on any of the statutory requirements? That's it. It's not bad. It's only a few. It's only 40 minutes of talking.
Andy, just a quick question.
Yeah.
I suppose we're still unclear on the whole employee thing, which we're not currently. We're both self-employed. We also do other work for other organizations and self-employed workers. If you're going to try and get some type of clear steer on, are you an employer or not your employee, would your accountant look at that and give you
your accountant would? I mean, I could. It depends on a number of things. The chances are you probably are employed. You can be employed and self-employed at the same time. You can be employed and self-employed by the same person at the same time. So, it's about the nature of the relationship between the two parties involved. And for each transaction, the nature of the relationship. Yeah. So, it's quite rare. You don't often see people being employed and self-employed at the same time, but it is possible.
Okay.
What's your organization?
Rabble is a cooperative. There's at this point, 2 directors and 2 members, so it's relatively new.
Okay, so directors can't really can't be paid on a self-employed basis.
But the paid is for actually work carried out on behalf of the cooperative, so contracts that we do get.
Yeah, I know. It's so the law is actually in your favor, and it is technically possible for you to fight HMRC on this. However, HMRC's default position is directors should not be being paid on a self-employed basis for work that is related to the general business of the company. Yep. And then on the other things, it does depend quite a lot on control. Who has control and oversight? Where's the financial risk happening? All of those kind of things. Yeah.
Okay.
Yeah. So my gut feeling is that you're likely to be employed without realizing.
Yeah.
Yeah, but if you want to talk to me afterwards, then
Yeah, that'd be great.
Tiziana can give you my details and stuff.
Great. Thank you, Andy.
Cool. Okay, so basically to enable you to do all of this and to meet the requirements of the Companies Act and Cooperative and Community Benefit Societies Act, you need to have good record keeping. That's just the basics. You just need to start keeping records. A good record keeping, having worked as an accountant or prepared end-of-year accounts for various organizations, good record keeping is not a copy of every single receipt you've ever had in a shoebox. I mean, that will just about get by. And if you turn up for me with a shoebox, I will charge you an arm and a leg, because and so would any other sensible accountant. Good record keeping is you actually on a day-to-day basis or a week-to-week basis inputting into a system what has happened. Yeah, and yes, having a hard copy or an electronic copy of the invoice or the bill is all good, but it's not the be-all and end-all. You also need to actually have some system in place. Yeah. And if you have good records, then the other stuff is actually relatively straightforward. Or if it's beyond what you can do, you can say, here's my records. Can you file the returns, please, to an accountant? And they'll charge you, but they won't charge you as much, because like the keeping records bit is boring. Yeah, but it's not difficult. It is tedious, mind-numbingly dull. You have to listen to aggressive music whilst you're doing it, because otherwise you're just going to die. Having spent some of my life as a bookkeeper, yeah. But you can do it I can do it half asleep. But no accountant wants to spend their time doing that, because it's just fucking dull. So they'll charge you a lot of money, yeah. If you've done all of that stuff and you give it to your accountant, they'll do the other stuff for you, because it's, you know, yeah, and they won't charge you anywhere near as much. So you really need to keep the records. Yeah. Don't expect somebody else to do it. You could employ a bookkeeper, that's fine, but you need to keep your records. And your records must be kept in a form called double entry bookkeeping. And this worries people, but it's not worrying at all. It's just a complicated name for a very simple concept. And what we mean by double entry bookkeeping is that when we are doing our accounts, money doesn't just appear in our accounts or disappear from our accounts. It comes from somewhere, or it goes to somewhere. Yeah, it doesn't just, we don't just suddenly go, oh, look, there's £1,000 in my bank account. Well, hey, that's nice, isn't it? We say there's £1,000 in my bank account that has come from the sales that I did. Yeah. So there's two transactions and they balance, they match. So there can be more than two transactions. There can be more than two entries. A transaction can be split across many different accounts. That doesn't matter, but it's entered at least twice in two different accounts. I'm not going to, there isn't time to do a whole, what are the different types of accounts, what are accounts, all of that. But when we're doing double entry bookkeeping, we're making sure that everything has got some form of explanation. So even if you're just doing a spreadsheet, yeah, what you're saying is the money that's coming. So I've got £1,000 that's appeared in my bank account, and that's sales. I have spent £500 from my bank account, and that's insurance. Yeah, so there's always an explanation as to where it's come from or where it's gone to. So for instance, if I was paying my insurance, well, where does it happen? It happens in my bank account. I'm going to spend £500 in my bank account. Yeah? And the transaction is paying my insurance. So what I will show in my bookkeeping system is that my asset account, which is called my bank account, will decrease by £500. And my expense account, which is called insurance, would increase by £500. That's all we mean by double entry bookkeeping. But it now means that I got a list of all the money that I've spent on insurance. That's my insurance account. It's all the money I've spent on insurance. Yeah. And I know how much cash I've got. Yeah. So how do we do this double entry bookkeeping? Well, there's kind of three approaches, and I strongly don't recommend one of them. So there is nothing illegal about keeping ledgers. You could have a book like they used to have in the old films, big ginormous book with lots of pages and lots of columns. And why the fuck would you do that? But you could, yeah. You know, you're going to spend, the chances of error are quite high, and your ability to find the error is quite low. Yeah. So you could use spreadsheets instead, which are effectively, that is actually what a spreadsheet is. A spreadsheet is a ledger. That's how it was originally, they were originally designed. They were designed to do ledgers for books of accounts, but the computer adds everything up for you. That's one potential source of error gone. Or you can use accounting software. And we'll go through what these things look like. So I'm not going to go through ledgers because I don't recommend them. Just, you don't let me tell you that it's illegal to keep ledgers, because it's not. You could keep everything as ledgers if you wanted to. I have worked with a whole food shop, like not a small co-op, a proper whole food shop, with a turnover of about 500,000 a year, who only 4 years ago maybe, moved away from keeping ledgers. And it was because the person who kept the books didn't want to learn accounting software. So they're still keeping ledgers, and it's perfectly fine, but don't do it. So spreadsheets is the next step up, really. And I'm not going to say don't keep spreadsheets. If you are small and your accounts are not complicated. So by complicated, I mean, do people owe you money? Do you write invoices and wait for people to pay them? Are you trying to track that? Do you have things, assets that need to be depreciated? Do you owe people money? Are you employing anyone? Do you have transactions that are split? So they include lots of different things like employing people. The transaction is really complicated. You've got the gross wage, which is expense from the business. And you've got the employer's national insurance contribution, which is an expense from the business. And you've got the employer's pension contributions, which is an expense from the business. And then you've got a number of things that aren't expenses from the business, which you've deducted from their wages, such as income tax, employees' national insurance contributions, employees' pension contributions. And then you've got the amount that you actually pay them. And all of those things kind of have to fit into one transaction. So the more complicated that is, the more difficult it is to do this effectively with spreadsheets. But you can do it, and I've written spreadsheets. Again, they work better if you understand the sort of formulas that go into spreadsheets. So it's not just a list. Yeah. You don't just write a list, because you need to be able to sum all the different things. So you want to know what all the expenditure on insurance was. You want to know what all the expenditure on PAYE was. And that works much better if you understand the sort of the summing, the ifs and the if sums functions. Then you can write a decent spreadsheet. If you can't do that, then I don't suggest you use a spreadsheet. Because again, your accountant will get annoyed with you. And the reason why I say it's a problem if your accountant gets annoyed with you is if your accountant gets annoyed with you, they charge you money. Yeah, they're expensive. So you really, unless you know what you're doing, I would use bookkeeping software. And there's a big choice to make right at the start, really. So do you want to use the sort of free and open source bookkeeping software, such as GNU Cash, KMO Money? I don't know it as well, but I know GNU Cash very well. It's really good. And I would say these are great. These are really good if you have a relatively simple set of accounts. You know, Radical Roots' accounts are done in GNU Cash, and Radical Roots has got you know, share capital of £1 million. It's not like about the size of your turnover, but it's not VAT registered. This doesn't work very well if you're VAT registered, because they're not making tax digital compliant, and you generally need to have your separate PAYE system. But they work on a ledger style system, so you would basically put in the date, what the type of transaction was, and then importantly, this double entry side thing, what account is the money going to or coming from, how much you put in, and what the balance is, and provides a running balance. And you've got many different types of accounts that will do this for, and then it produce reports for you at the year end. And you can use this if you're doing invoices to track your money, all of those kind of things. So I used to do all my books in GNU Cash. I am very happy if someone sends me, you know, to write accounts for people who send me a GNU Cash file. The problem is once you start to, well, one, you have to keep a separate PAYE system, because it doesn't provide real-time information PAYE reporting, and it doesn't work at the point that you become VAT registered. So if you're never going to become VAT registered, it's fine. If you become VAT registered, out the window, you're going to have to go for making tax digital compliant software. Then there's all the proprietary ones. So QuickBooks, Free Agent, Xero are the three main online ones. QuickBooks and Xero are probably bigger than Free Agent. And lastly, Sage. Now, I do not recommend that any of you use Sage. You need a degree in Sage to be able to use Sage. So it works. Sage is exceptionally effective at managing large organizations. That's what it's for. But even if your accountant says, can you please use Sage, say no, because you actually need a degree in Sage. And I'd rather you went and got a degree in accounting and had some transferable skills, you know. If you wanted my preference for all of them, I'd say QuickBooks. I use it a fair bit. I found it easier than the other two. I've used all of them. I have actually used Sage, although I hate it. But I've used the other, you know, the first three. But out of the three of them, QuickBooks is my my preference. Then these days, the way their business model has changed, and you used to buy software, and it sat on your computer, and then it was your software. You could do what you wanted with it. Yeah. But that doesn't work anymore. Or they will still allow it, but they're kind of shifting everyone to cloud-based software. So you basically have a monthly fee. So obviously your monthly fee is less, but I imagine you'll pay more in the long run. The major advantage is because this cloud-based, like they'll update, most of these will change their payroll system or their VAT system, or when it comes in their corporation tax reporting, so that they are making tax digital compliant or real-time information compliant. So that's the big advantage. If you're going to be required to do one of those, I'd go with one of the online ones. They're designed for idiots. That's how they think. Yeah. So they're designed to make everything really simple graphical user interface, everyday tasks, very user-friendly. I mean, QuickBooks is American, and it says, awesome, you've just completed your first reconciliation. And, you know, it's just like, oh. Where they fall down is if you're trying to do sort of complex transactions and you understand accounting and you want to try and move grants around or things like that. And that's because there's not something that everybody would have to do. So they haven't got a simple user interface for it. And then everything else is hidden behind this simple user interface. So it's a lot harder to do the more complicated stuff. But, you know, again, for most people, that's not a problem. The other great advantage about them is that they will depending on who you've got your bank account with, but they'll mostly download your bank transactions for you straight into the system, which again reduces the amount of errors that you have. Certainly with QuickBooks, even if it won't talk to your bank, you will download your bank transactions as a CSV file, which is comma separated value, the sort of Excel, the spreadsheet type thing, and then you just upload that. So again, there's less problems, there's less user error, yeah, input error. If you do have an accountant, it's worth talking to your accountant about which one they prefer. And then I don't know if they all do this, but certainly QuickBooks, your accountant can be a registered accountant or have an accounting practice on QuickBooks. And if you subscribe through them, you get half price, which is worth doing. Yeah, half price is half price. You know, it looks all shiny and it gives you graphics and it goes, oh, this is not what you've not done yet, and yeah, whatever. You know, whatever system you use, whatever system, you need to reconcile. Okay? So what we need to do is we need to enter our transactions and explain them, match them, explain them. They've all got different language, but you know, on a regular basis, every week, day to day, depends how many you've got, yeah. And then once a month, or at the very least before filing any return. So if you've got a VAT return, at least before you file your VAT return, yeah, you need to reconcile your accounts. And this is just a way of checking that we haven't made any errors. And what we do is we say, okay, well, how much did we say was in our bank on the 31st of May? How much did we say was in this account, according to our bookkeeping software, on the 31st of May, 2022? And how much does the bank statement say is in there? Do they match? Yes, great, reconcile. No, where's the error? And you do that with all of your accounts. It's not just your bank account, but also like your credit card account, your petty cash. You just add up the money in the petty cash, Tim. Does it match? You should do it with loans and things like that, but you'll get the statements a lot less frequently. But it's just a case of matching the statements that you get given with what you've got in your records. It's really important. If you don't reconcile, again, you're likely to have errors, and the errors are much harder to correct after you've filed reports, because you've got to file a I fucked up report as well as the actual report. Yeah, so do the reconciliation before you file reports. How are we doing? Am I making you all go slightly like, why am I doing this? do I really want to run a business? Or are we all okay?
No, it's great. Thanks.
We are okay. We're okay. Keep
Good,
going.
good.
It's
Keep
good.
going.
It's good to have all these details, Andy. Thank you. It's really good. It makes people think and reflect on what we are doing. All of us.
Yeah, you were a business, Tiziana. You should be thinking about these things. Okay, so that's the kind of boring stuff, really. But it's you've just got to do it. So it doesn't matter what business you are, you've got to, you'll fit into one of those categories, and you'll have to do some of those things. Yeah. So now we're on to the more interesting stuff. So I suggest for all businesses that they produce reports, and they look at these reports on a regular basis. And these reports are called management accounts. And you should always be looking at your management accounts. Yeah? What a management account is the regular presentation of financial information to the decision makers in the business with the object of enabling them to make informed business decisions. So how often should you be looking at your management accounts? Well, before you make a business decision. Yeah? So you should be looking at them relatively frequently. And they shall include things like your profit and loss, your cash flow statement, your balance sheet, accounts receivable. There are various things that you can put in there. What should go in there should change over time depending on what kind of business decisions you're making and how you are. Are you in a period of growth? Are you in a period of consolidation? All of these kind of things. And I do a whole workshop on the different reports, and I think Tiziana's even been on it, in fact, so she can say whether it's any good or not. But the one I'm going to
very good.
Thank you. The one I'm going to focus on for the time that we have left in this workshop is cash flow forecasting, because I actually think it's one of the most important. So all those other things that I talked about, look at what has happened. Whereas obviously with a forecast, we're predicting what may happen. No, it's not what is going to happen, it's what may happen. Now, I've worked with organizations who've got 50 plus, 60 plus million turnover, who don't do this because we're always wrong. It's always out. I say, yeah, of course it is. It's a forecast. Yeah, we're not expecting you to get it right. If you can predict what's going to happen in the future, then, well, tell me what the lottery numbers are going to be next week. It's like, it's just not, we just can't, can we? But what we're trying to do here is notice when issues are going to arise. Yeah, so we're going to be out, and don't get hung up on making sure every single time you do a forecast it is completely right, because it won't be. However, the more times you do a forecast for your business, the better your forecasting ability is going to be. Yeah. So what is a cash flow forecast? Well, it looks at all the money that goes into and out of your business at regular intervals, and what those intervals are, how long or how short those intervals are, depend upon how predictable your business is, how predictable the cash flows are, how much money is flowing through your business, your stage in the business cycle. So what I mean by that is, are you growing, or are you kind of consolidating and just kind of staying the same? Yeah. Or are you declining, obviously? And how tight your cash flows are. So tight cash flows are, if you imagine like your business is a sieve, and the money flowing through, the cash flowing through your business is the water or the flour or whatever. Yeah. How much of it you grab. Yeah? If you grab a small amount, large amounts flows through, and you only grab a small amount, then you've got tight cash flows. Yeah. If you grab loads of whatever flows through, then your cash flow is not tight, it's loose. I think that's the opposite of tight. No one ever really refers to it in that way. So if you're a bakery or a shop, or something with large cash flows, then you should look at the interval being weekly, yeah? Or if you think you're going to have cash flow related issues, or you're in a period of rapid growth. I said earlier that over 80% of all the businesses that go insolvent in the UK go insolvent because they run out of cash. One of the times that you're at most at risk of running out of cash is in a period of growth or expansion, especially rapid growth or rapid expansion. And that's usually because you overtrade. Yeah? You have to, there's a time difference between when you buy things that you then sell and when you realize the money on that. And obviously if you're growing, then the last lot of money that you've realized is less than the new amount of money that you're having to buy. So you can actually run out of cash quite quickly if you're growing. So just be aware of that, yeah, if you're in one of those growth periods. If your cash flows are relatively predictable, you know, if what you do is get grants and then deliver services, you know when the money is coming in, yeah. If you generate electricity, you know every quarter you're going to get this much money. If you're a housing co-op, you've got a relatively good idea that every month you're going to get this much money. You don't have to think about it weekly. You can do much more like a monthly based cash flow forecast. The important thing to think about with a cash flow forecast is usually when we're doing accounting, we're not massively interested in the date when money changes hands. We are a bit. We obviously have to account for that, but we recognize income at points that are different to the point when money changes hands. So we recognize income at the point that we write the invoice, usually, not always. Or if we get a grant, we recognize the income at the point when we've delivered the thing that the grant was for. That's when we recognize the income. Now, in a cash flow forecast, we're not interested in that. What we're actually interested in is at what point does money arrive in my bank account or in my till? At what point does money leave my bank account or leave my till? So actually when cash changes hands, yeah? Not when am I going to write this invoice, but when is this invoice going to get paid? For most of the time, what we're interested in is, let's do a cash flow forecast for the following year. Yeah, once you get beyond a year, it starts to get quite, I don't know. Yeah, you've got a relatively good idea of what's going to happen the next year. And it enables us to make plans around that. Yeah. But if you're borrowing money from a bank, it's the last session, we did talk about that quite a bit. They're going to want to see a cash flow forecast for the length of the loan. So I write 40-year cash flow forecasts. It's nonsense because, what the hell is going to happen in 40 years' time? But that's what they want to see. Yeah. It's mostly for the more predictable things like, it's usually things like housing co-ops that get 4-year lengths. So, you know roughly what the rental levels are going to be. But for the day-to-day stuff that I'm talking about, following year is what we're after. So there's different ways of doing it. You can divide it up into these different areas. So the operating, the sort of day-to-day, the trade, money that comes in from your customers, money that goes out to your suppliers. The investing, which is the internal investment in the business, which is buying the big stuff that you need to keep going, a new premises, a new printing press, whatever, a new oven, and the financing, which is, where did this money come from? I think this is the best, personally, I think this is the best way of doing it. And the things that I'd like to see in a cash flow forecast are lots of big headings, not too much detail. Because the alternative approach is something that looks like this. And there are a number of problems with a cash flow forecast that looks like this. One is it's kind of a cross between a profit and loss forecast and a cash flow forecast. So it's got the cash related stuff down here, loan repayments and whatever, but this is like, I don't think you're going to spend £66.67 on accountancy every month. I think in 1 month, you're going to spend £66.67 times 12, whatever that is. 750, I guess. No, it won't be 750, but something like that. Because that's when the money actually changes hands. So you shouldn't just divide up your annual cost by 12, because that's not when the money changes hands. And I can guarantee you, having sat through these meetings, that people will be arguing with you about why you're spending £43.33 on laundry in February, rather than why are we going to run out of cash in 2020? And actually, that's what I'm interested in. Yeah, this is what I said to you. The thing that you're doing a cash flow forecast for is to work out, you're not going to be accurate, but it's to work out when the crunch points are. When are you going to be facing difficulties? When do you need to be aware of your cash flow? When are you going to have to go and borrow some money? When are you going to have to put off expenditure? When are you going to have to basically be onto your clients and go, come on, you've got to pay me. Come on, you've got to pay me. Yeah. And this stops you seeing that because of the detail. And I've just sat through those meetings, and they will. It's like, oh, is there anything we can do to reduce the phone bill in March? Who cares? £17.33. Who cares? Yeah? Why are there no sales in that month? Big stuff. Yeah. If you're in the finance team, the detailed breakdown is quite useful because it enables you to do better and more accurate forecasting. And it's because you can just check whether your spends have happened, whether you can use them to create budgets. But when you're presenting it to the wider group, it's just too detailed. Yeah. The detailed breakdown is also useful for the next part of what I'm talking about, which is scenario planning, because you can alter individual lines based on scenarios. But once you've done your scenario planning, you again should present it to the co-op in a summary format. And there's nothing wrong with this level of summary. This is actually mostly what the co-op needs to see. They might want to ask questions, but I can scan this and go, okay, well, I don't have to worry. I don't have to argue about what's happening in, from September onwards, even if there's an increase in cash out in December. That's not really relevant. I'm not going to run out of cash in this period. What I want to know is, what are we going to do about this? Do we just need more working capital? No. Do we just need to borrow £1,000? I mean, let's just say that's $1 million and make it more realistic figures. But do we just need to have a buffer because we know we're going to get past it? That's the more useful thing. Yeah. It's trends and issues. Trends and issues, all we're really interested in when we're doing this, because the detail is going to be wrong. Yeah. Okay, so my main job isn't these webinars, and it isn't preparing end of year accounts. My main job is actually helping co-ops raise capital. So I have seen an awful lot of cash flow forecasts, because before you raise capital, one of the things you have to do is do a cash flow forecast that you can give to your investors or the bank or whoever to say, Look at us. We're going to be fine. We're going to be able to pay you back your cash. And because what they're trying to do is tell you that they're going to be able to pay back your cash, they make a number of very rosy assumptions. And then they put these rosy assumptions into a spreadsheet and go, look, the spreadsheet says everything's going to be wonderful. Well, of course it does, because all the spreadsheet does is adds up the assumptions that you put in and spits out the answer. So if you put in a load of rosy assumptions, the output is going to be rosy. From a business management point of view, that makes no sense at all. It's a very good approach if you're trying to, well, I say a good approach. It's a strategically useful approach if you're trying to part fools from their cash. It's not necessarily the best approach when you're trying to work out what's going to happen to your business. So the best use of a cash flow forecast isn't in this baseline assumptions, although the trends and the tight points are very useful. But the best use of it is in risk management and scenario planning. So what you actually want to do is you want to model what would happen to our cash if this happens, if that happens, if the other happens. And some of these are all like bad things. You know, what happens if you and a colleague fall sick was something that was only relevant to small workers' co-ops, but now it's obviously relevant to quite large organizations can have a whole shift pattern have to go off, yeah, with corona or whatever. But also there's the what happens on the positive side. What happens if we actually have to just suddenly grow very quickly? What effect is that going to have on our cash position? And the way that we should work this out is we should use some form of strategic management process. And you can go on entire workshops for entire weekends where you talk about the different risk management strategies. And to be honest, I don't really care. They're kind of all the same. So I don't care which one you do. What I do care about is that you do one, and that it is a logical, coherent process. So the other thing I see quite a bit is I ask people to, one of the things that you need to do to get the standard mark if you're doing a share offer is have a risk assessment to the business. And so because it's often an afterthought and they've had loads of documents to write, they just kind of go, oh, here's some risks. Oh, let's give them a threat score of this. Let's say, are those the actual risks that are going to affect your business? And are they as severe or as you think they are, or are they more severe or less severe? Yeah. So what you need to have is some process where you can identify all the risks. That process is up to you. I'm going to suggest one, but it's totally up to you. And then the severity, what is meant by the severity of the risk is what effect would it have upon my cash position, on how much cash I have, if that risk happened? Yeah, and a severe risk is one that will mess up my cash position, and a non-severe risk is one that I can kind of go, oh wow. Yeah? And the reason this is important as well is I've seen co-ops have some really complex and beautifully detailed and wonderful risk analysis with loads of marvelous mitigation strategies. And you think, blimey, I think that mitigation strategies actually probably costs you more money than what would happen if the risk actually occurred. So you want to see what happens, yeah? So to identify the risks, use some kind of trend analysis. People often talk about PESTLE, I don't care, whatever. Look at what's happening in the wider world. Yeah, that's all that this is. This is just, I mean, if you can find something that isn't political, economic, societal, technological, legal, or environmental, I'll be impressed. Yeah, this is, look at the wider world. Apply the wider world and the trends that are going on in the wider world to my business. And that's what SWOT analysis is. You look at the trends and you mix the strengths and weaknesses to look at the opportunity, to create the opportunities and threats. And those threats here, yeah, the threats that you know, whatever the combination of the wider world to your business is, are the risks in your risk analysis. And then you need to model those risks. And what I mean by model them is what effect would it have on my cash flow if that happened? And only at the point that you go, bugger, that's quite severe. That's I have to do something about that. Do you plan against it? Yeah. How do you stop the risk from happening? If you can't stop the risk from happening, what's your plan to deal with it when it does? And now it's time for questions. Sorry, I probably talked a lot.
Thank you. It was a very, very detailed overview of our responsibilities and duties, and now I feel I needed to do even more. But thank you. And I think that what was interesting for me, Andy, your connection with the risk register that you keep with the cash flow. That it's an interesting connection that probably I never emphasized too much. I do risk register, but then you needed to connect it to the cash flow. I think that is
It's the missing link.
Absolutely. And I think it is, Andy, it's my learning for today. We have also groups here that are, you know, board members. So I think that some of the board members of some of the co-ops do feel kind of a good responsibility as well to develop those systems. But I shut up now. Please do ask questions to Andy. As you can see, he has the experience.
Hi, Andy. Thanks for the presentation. Since I'm based in Ireland, the last part was the most relevant to me, but I think there's analogies anyway between the UK and Ireland in certain things. So it's also good to know what's happening next door. But yeah, the last part was really insightful. For me, the big takeaway is to not get mixed between, as you said, the profit and loss balance sheet and the forecasting, because that's what we're doing. I think at the moment, that's our big mistake. We're getting, when we do the forecasting, we have all this detail. We don't look at the big picture. And it's funny, we have an external accountant who gives us some direction, and he's always looking at the very bottom. And as you said, looking at which month we're going to be running out of cash. And do we need a loan? Or do we need to postpone the payment of the loan? So we're looking at those kind of things. So that was great. Thanks. That was very, very useful. Yeah. So I would welcome more information on this.
That's cool. If you give me your details, Eleanor, I will. I'll let you know when I do the day-long workshop, which probably these days, because it's always going to be online, because I now live in North Germany, it's going to be 2 half days. But yeah,
I think that would be a good idea, Andy. It's really important to continue this education of financial education that we don't have access here in Northern Ireland as much as because you are specialized more on co-ops. So
yeah, I mean, I do it for Co-ops UK, and I think, well, I've already done it for this year, so there's probably I don't think there's another one this year. I'll have a look, but it might be next year. But yeah, or always happy to do one for your organization as well. So if your organization wants me to do one, then I can, for a little bit more, I can use your organization's accounts rather than the generic accounts that I, you know. So the generic one is great, but it can be sometimes like I've done it with like directors of the retail society, the large retail societies, and a small housing co-op in the same room. And I'm like, you've got quite a different needs here, yeah? So if you want me to look at your accounts, then we can do that as well.
So you could actually work with some boards as well. So if a board requires you, okay, fantastic, fantastic.
Yeah,
to
so
know.
I do that for quite a few organizations, like training board.
Andy, just to explore the level of services, do you also help maybe cooperatives to set up maybe the initial software, or help them with a bit of bookkeeping more in detail?
So you know, I'm a bit too in demand to I tend to choose the co-ops that I either really like because I've got a particular affinity with, to do that, or the work that is better paid, stroke more interesting.
Okay.
Just being honest, but you know, I also am in a co-op called Catalyst Collective, which does do bookkeeping support for organizations, and we may have capacity, so it is worth getting in touch. I just can't promise, you know.
No. We are not going to hold you to that, but it's nice that there are organizations out there, you know, that could help, and it's a different route than the traditional accountants. We found sometimes traditional accountants do not have that specific knowledge of cooperation or cooperatives, sorry, and sometimes it's kind of difficult to deal with that. Now we have in Northern Ireland, we have a couple, and I'm sure that in the South they have a couple, but it's a more kind of supportive through the movement to have you know, cooperatives helping other cooperatives. Thank you. Bessie, you wanted to say a couple of final words, and then we go.
Thanks very much for that, Andy. It was really useful. I mean, where we're at with the bookkeeping stuff, we've been using. We started with GNU Cash, and we ended up with My Money, and found it much more just intuitive than GNU Cash, and it's great for doing projections and all that. It's kind of baked in, so we found that really well. And so we've done like kind of really basic sort of cash flow core forecasting. We're relatively new, so we're starting to see the money coming in. To some elements, it's a bit predictable. Where we're shaky, and it's probably when we get to grips with it, it'll be fine. It's just the legal stuff. So the employment stuff, and are we self-employed, or we what? We know what our preference is, and we're working to our preference currently. But there's just that nagging thing going, shit, is something going to creep up later here? And so we just, if we could get, I mean, we're just looking for a steer on that. And then we need to settle into a relationship with an accountant who can really kind of lift some of this stuff for us. The day-to-day bookkeeping stuff, I think we're pretty tight on, you know. It's just then those other requirements. So any steers that you could give, or recommendations, or anything like that? If you want to,
like, maybe probably better when the recording's not on, but we could stay, because I was booked in for another half an hour, because I thought there might be more questions. So I'm happy to hang around straight after this and talk to you.
That's, if you could, that'd be fantastic.
Yeah. I just, perhaps you might not want it recorded.
I think that you can actually stay online even if I'm going away. I'm the host.
Brilliant, Tatiana.
Yeah, so that you can have that kind of consultation. So we may wanted to now then keep go to a close. Thank you, Andy, for your intervention here in Northern Ireland. We know now that you are around there, and I hope some of the new co-ops would you know, get helped by you. If you don't mind, would you like to express a comment of what you liked about today's webinars for the Belfast City Council, that they are asking a quick evaluation in the chat? Just to say what you have liked, what you would like to see more, if you don't mind, just 2 minutes. I know I put Elena and Bessie on the spot. I'm very sorry, but we find that the webinars have been useful and interesting, but they are not as well attended as they were a few years ago. I think people is getting tired, or maybe we needed to go even more specialized. So specific to the needs of particular groupings of cooperative, just to put some ideas out there. Remember, these are supported by the Belfast City Council, so a good support we wanted to put a good use. Yeah. So after that, I will say thank you very much. And I'm going to close this session here for us, and you can carry on, hopefully, to continue to talk. Otherwise, you reconnect through Zoom. I guess that is the other option you have.
Thank you, Tiziana.
Thank you. Thank you very much. Thank you, Elena. Bye-bye.
Thank you.
Nice
Bye-bye.
meeting you.
Bye-bye.
Cheers. Bye.